option is, let's say now the insurance company says, okay, we had a great year, we had a positive profit, so we're going to be sharing that profit with our dividend, with our policyholders, with our participating policyholders. So you have an option. Do you want it as cash? That means they will just mail out a check, not like physical cash, but mail out a check to you pretty much like cash. You go and you deposit and you're able to withdraw that money, right? So very simple. Let's say that this year your profit is, I don't know, $1,200. So they can email a check, mail a check to you for $1,200, right? The next option that you have, let's say you don't want it as a check, you want premium reduction. And just as the name suggests, so rather than them sending you that $1,200, and that's just for illustration, could be less, could be more, just as an example, rather than them sending you that $1,200, they can apply that to your premiums. So reduce your premiums. So you're using that to pay the premiums for you, right? So you can have that option. You can have accumulation. That means that every year, whenever you have, whenever you're entitled to that profit, instead of sending it to you, they just put it for you in a side account. So this year, maybe it's $1,200, next year might be $800, the year after might be $1,000, so $3,000. So you have that, and it continues to build and it continues to grow, right? And again, taxation does apply. So when we cover the taxation segment, we'll look at all of that and how that works. But you do have that option. So if you don't want it in small chunks, maybe you just want to build it up and put it in an account, you can do that as well. PUA stands for paid up additions. So let's say you are someone who maybe wants more insurance. So whatever your, let's say this year was $1,200, for example, instead of sending you that or instead of putting it in an account, they can take that $1,200, use it as a one-time single payment for more insurance. So whatever the maximum amount you can get with a $1,200 premium, it might be $20,000 extra insurance, it might be $30,000 extra insurance, whatever that maximum is, they will get that for you and it will be added to your death benefit. So if somebody has a death benefit of, let's say, $500,000 and they get paid up additions, so every time then they're just adding more to the face amount, to the death benefit, right? And this is great for someone who is worried about inflation or those kinds of things. If they're worried about, cost of living going up, they can add this as their option. That way that extra amount can kind of offset for that inflation as well. And the last option you have is term insurance. So you can get additional term insurance as well. If that's one of the options that you would like to get, then what they would do again is take that maximum premium and whatever the maximum that will be able to get you, you would get term insurance for that, right? So instead of permanent insurance, it's term. So it is something that it will be more because when you get term insurance, it's cheaper. So you might get more. But what's important here is that term insurance is only for 1 year, right? So it's valid only for 1 year. It's not something that's T10, T20, it's 1 year term, right? So you have that option. These are the options that are there if somebody is part of a participating policy and they want to get the dividend options. There are also non-forfeiture options. That means that if you don't want to forfeit the plan, what are some other options you have with whole life? So one of them is you can take a policy loan. So you can borrow from your policy. It does create, again, taxes will be there. But let's say if there's no other place you can borrow, somebody's in need of money, they have no other place they can borrow money. They can take up to 90% of their cash surrender value. So whatever they've built into that as a loan. So you would put it back eventually, but you can, at least it's another safety net that you have somewhere else you can take money from. There's also APL, which stands for automatic premium loan. So you can use your cash surrender value, one more I forgot, to pay up your premiums. So let's say if you are not able to pay your premiums for a year, so whatever money is sitting in there can be used to apply for a premium, automatic premium loan. ETI stands for extended term insurance. And again, you can use that to get extended term insurance as well. So there's a lot of other options that come with whole life that are not there with term or term 100. All right, so what are some of the advantages and disadvantages now of term? Advantages, one, it's a guaranteed premium. So premium is not fluctuating anywhere, it's staying the same. You may get dividends, so you have the option to participate, and if there's a profit, you may get those dividends. And of course, cash surrender value, one of the biggest plus points, biggest selling points of whole life. Disadvantages is that initially the costs seem high. So high initial costs to sort of balance out for the future when the costs are, it's going to stay the same. So it's meant to do that. And another disadvantage is that there's no choice of investment. So when you're paying the premium, insurance company is investing that money. And for someone who might like to be a part of that or want to see where their money is going or want to have a say in the investment, it's not the best product for them because you don't get a say. They just take it and they invest where they feel is the best place, but the client has no say in that. And another disadvantage also is that the dividends are not guaranteed. So insurance company may not have a profit for a few years. So you're not actually guaranteed to get that dividend, right? So this is whole life in a nutshell. There's a lot more to it, which includes taxation. So like I said, we'll cover that in a later segment. So who is the ideal person? What kind of a scenario are you looking for when we look at whole life? Who should be the person that we look for? So this is appropriate when the policyholder, so they're looking for something for the rest of their life. That's when you can recommend whole life. They want to leave something behind to their kids or grandkids, leave some sort of like inheritance for them. That's where whole life is a great product. They also would like to, they're willing to pay premiums for the rest of their life, right? So if they're not able to pay premiums for the rest of their life, maybe in their later years, may not be the best product because you do have to pay premiums for the rest of your life as well. And also for someone who does not really want any sort of investment options, they just want to have some participating options and are okay with that. So those are kind of like the ideal persons that we're looking for when we talk about whole life. All right, so thank you so much for joining me. And then join for the next segment, we'll be looking at UL, which is universal life, the final life insurance product, and then we'll be switching over to taxation and other uses for life insurance.